An unprecedented stimulus package has been unveiled for China. This is really unlike anything we've seen before. This new stimulus approach in China is meant to revitalize what is a collapsing Chinese economy. Go big or go home, right? Now, before we get into China's stimulus and how that is going to affect our markets, how that could affect inflation, we also have some data out today that does not look good for the US labor market. And this is of the utmost importance. But first, last night, China went all in on a stimulus package, sending Chinese stocks 4% higher. These are the following actions that China just took. 1, they lowered the policy interest rates and signaled more cuts are coming. They cut rates on over $5 trillion in mortgages. They eased rules for second home purchases. They lowered the required reserve ratio for banks, freeing up fresh liquidity. They pledged over $100 billion in equity market support. They also stated that policymakers were studying a stock market stabilization fund. So yes, you heard that right. China will allow securities firms, funds, and insurers to tap PBOC funds to buy stock to the degree of 500 billion won, which does translate to about $100 billion. As Jim Bianco correctly puts it on X, the People's Bank of China, the PBOC, is panicking. The question that we all have following this panic from China's central bank is, how will this affect our markets? And I think we've already started to feel the effects of this now for a couple of days. What I mean by this is 10-year treasury yields every day since the Fed has cut rates have been moving higher, up now about 11 basis points since the Fed cut rates. This is actually tightening financial conditions here in the US, presumably because of these Chinese stimulus measures that could raise some inflation. If you take a look at commodities today, like oil across the board is up about 1.5% today. Other commodities such as precious metals like gold is up 1%, silver is up 4.5%, copper is up 3.3%, steel is up 3.5%, and even platinum is up almost 3% today. Food commodities are generally higher today. Orange juice up 2.3%, canola up 2.5%, sugar's up 2.66% today. Industrial commodities like bitumen is up 2.5%, lead is up 1.5%, aluminum's up 2.6%, zinc is up 4.5%, tin is up 1%, nickel's up 1%, palladium is up 2.1%, and germanium is up 1.64%. So generally speaking, inflationary pressures are moving higher today, which commodities are one of the biggest input costs to companies, if not the biggest input cost to some companies. That is problematic. Now, the question really is, will this boost inflation in the US? I personally don't think so, and I'll tell you why. Inflation is really just the practice of passing cost onto consumers. If consumers are not willing to pay the higher prices and demand does not go up in lockstep with prices, then you do not see inflation. So inflation, by that definition, is more so an economic barometer. If people are not doing as well, if they don't feel as confident, if they are just not willing to pay higher prices, then prices are not gonna go higher. Now, if people are doing great and they feel fine and they have stable jobs or whatnot, they may be willing to pay higher prices, and that's where you get inflation. And that's why when you have a strong economy, you can tend to get inflation. When you have a weak economy, you don't see inflation. So in simpler terms, I think the economy is too weak right now to actually support inflation round 2. And we actually see that represented in the data that we got out today, in which we will cover in just a moment. So what does this mean if we see inflationary pressures to companies, but companies are not able to pass on those costs? What does that mean? That means company margins will have to take the hit of higher prices, instead of, again, passing that cost on to end consumers. So in fact, this may not actually be a huge inflationary wave or inflationary event for the US, but this could be a margin problem for companies. But we'll have to see just how much commodities go up in price or go up in value and what kind of effect that will have on corporate America. It's not necessarily a terrible thing. It could turn out to be that, but we just don't know at this point. So it's throwing a little bit more uncertainty on an already pretty uncertain economy and market. But the data that we got today is, well, bad. And we know that definitively. Consumer confidence weakened this morning as consumers worry about jobs, according to the CB Conference Board. Consumers' assessments of the labor market outlook were more pessimistic in September. 16.4% of consumers expected more jobs to be available, up slightly from 16.3% in August. But 18.3% anticipated fewer jobs, up from 17%. Despite slower overall inflation and declines in some goods prices, average 12-month inflation expectations increased to 5.2% in September. And the actual reading for this is jobs that were seen as less plentiful than the prior month came in at 30.9 versus estimates of 32.7. And these things tend to follow each other, okay? This white line is the unemployment rate. The yellow line is the Confidence Board jobs plentiful minus hard to get. When you see these things move, down, unemployment rates tend to be moving down, right? If the yellow line's down, white line's down. If they're going up, they're both typically going up. And that is starting to accelerate, which suggests the unemployment rate is going to go up as well. Which this does come after the University of Michigan's consumer sentiment report that also shows the views of the labor market that are weakening. This was on September 14th when you had the University of Michigan consumer sentiment, and it says more consumers expect unemployment to rise in the year ahead, 39%. The highest since June of 2023 versus 37% prior. This comes at the same time there is apparently a 97% chance of a recession based on the 12-month forward change in the Fed funds rate. I think that's down from 98% last week. And the average is 37% chance of a recession. What's actually very interesting, just going back to this jobs differentials. Again, consumer confidence, jobs plentiful minus jobs hard to find. This chart from Peter Burskin and BCA Research puts this into a perspective that I think is quite compelling. Usually when you see this start to plummet like we are now, you're going into a recession. You're like doorstep of a recession basically every single time looking back since the 60s. I mean, you don't normally see this fall and then just slowly go into a recession. Normally when this thing plummets, you are in a recession. Something that I think we want to watch pretty closely as well is the potential for an October 1st strike of 70,000 dock workers at East Coast and Gulf Coast ports. 41% of port volume in the U.S. could be impacted, all the way from Port Authority of New York to New Jersey to Port of Houston, per the National Association of Manufacturers. And if you take a look at total exports that are heading out of these ports, the Port of Austin's a pretty big one, 22.4 billion. Port of Miami, I thought was a little bit larger. It's only 5.1 billion. The Port of Savannah is a pretty big one at 15.9 billion. The Port of New York and New Jersey is the biggest at 22.9 billion. The Port of Virginia is 21.7 billion. And even the Port of Charleston is about 9 billion. And this is one of those 2 standard deviation black swan events that I've talked about that could be something that pushes us into a recession, which again, in my opinion, I think we are 1 standard deviation black swan event away from a recession, which that basically means in English, we are 1 exogenous event away from a recession. And I think closing down the whole East side of the country as far as the ports would definitely count as an exogenous event. And part of the problem perhaps right now in markets is the delusional Wall Street guys that just don't understand basic level principles of economics, like Yardini. This one's hard to hear. It says the U.S. is a tranquil island in a sea of troubles. The economy continues to grow. The Fed has effectively taken any recession risk off the table, as evidenced by the narrow spread between the composite yield of high-yield corporate bonds and the 10-year Treasury. I mean, just this sentence, the Fed has effectively taken any recession risk off the table, is something that just shows the incompetence level of a lot of people on Wall Street, when in all reality, the Fed just confirmed a recession, potentially with a 50 basis point rate cut. I mean, like, it could be the exact opposite of took recession risk off the table. Now, we will not know that until probably after the election, when economic data starts to come in more accurate. But what we're getting from these non-government data reports like the CB Consumer Confidence and the University of Michigan survey and corporate earnings so far, the likes of FedEx and a couple of others, Darden Restaurants was one that we got about 2 weeks ago. None of this sounds good at all. And it's starting to paint a very different picture than the picture that we hear from the Bureau of Labor Statistics or government data providers. And according to the former Commerce Secretary that just said, the U.S. will enter a mild recession as the economy deflates after its boost from unproductive stimulus cash. The employment component of the Richmond Fed Manufacturing Index, which just came out today, just broke through its 2020 pandemic low. As of September, it's at its lowest since April of 2009. My friends, there is a serious problem in the U.S. economy right now. Do not be confused by this. Yes, stocks can continue to go higher in the short term, over the next couple of weeks potentially. But this will not end well. There will be a day of reckoning in which Wall Street will all be caught with their pants down. Remember what Warren Buffett famously said: you don't really know who's swimming naked until the tide goes out. And he was referencing debt and leverage. And at the same time, you don't know how much damage will be done until the tide goes out. And you see just how many people that were actually swimming naked. And unfortunately for the Wall Streeters, they are so hell-bent on a soft landing, they won't even acknowledge the risk that is in front of us. And that is to your benefit when you do get this glorious buying opportunity, because Wall Street was caught with their pants down as the tide went out. You're going to be able to take advantage of that. Percent of stocks today trading above their 50-day moving average, something that I like to look at every single day, is sitting at 62.66%. You're up 3% today. About 1.8% of all stocks are breaking above their 50-day moving average today. So it's a pretty good day. Not a great day, but not a bad day either. Markets are currently pricing about a 52.8% chance of another 50 basis point rate cut coming November 7th, and only a 47.2% chance of a 25 basis point rate cut. That's actually interesting, because yesterday the odds were the opposite. Yesterday the odds were 55.6% chance of a 25 basis point cut and only a 44.4% chance of a 50 basis point cut. So the odds actually went higher today of a 50 basis point cut, following the bad Richmond manufacturing data that we got today, as well as the CB consumer confidence data that we got today. And again, that's because the employment aspect of both of these data points just came in really, really bad. You also had the S&P Case-Shiller home price month over month that came in at 0%. Estimates were of 0.4%. So home prices apparently did not go up last month in this country. And S&P Case-Shiller home prices year over year went up 5.9% versus estimates of 5.8%. We also have a weird kind of flip-flop flip-flop from Fed Bowman today. She says considerable pent-up demand and available cash ready to be used as interest rates fall, a risk to meeting the inflation goal. She also said the estimate of neutral rate is much higher than before the pandemic. Policy is not as restrictive as it may seem. Which again, even in spite of those more hawkish comments from Fed Bowman, you still seen the odds of a 50 basis point rate cut move higher. And like I've said before in many videos now, I do actually think September is going to be a good month for markets. I think the first half of October is probably going to be a good period for markets. I am still expecting some kind of election correction in the second half of October. It's really after the election. Second half of November, December, January, February, and March of 2025, the next 5 months or so, that I'm more concerned about. As far as that potential day of reckoning where the economic data starts to show a lot more of the weakness that we are seeing and feeling in real time in the economy. But let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.